Hello, good morning, everyone, and welcome to the Reuters session entitled Learn from the Disruptors, Discover the Key Auto Insurance Innovations That Are Changing the Industry. And wow, I can't imagine when we talk about the mobility ecosystem, all the different things that insurers are thinking about, when we see what's happening in the world of autonomy, connectivity, multimodality, and people, really needing to be safe regardless what form of transit they're utilizing. So just to give you a little bit of housekeeping and ground rules, we're going to have each of our presenters today that I will shortly introduce spend about 10 minutes giving their view, and then we'll have time for Q&A after everyone is finished for about 20-25 minutes. And as we go through, if you'd like to add questions to the Q&A box, I'll be reviewing that from time to time. I've also got my own set queued up as well, and I'll probably even get more as I listen to these great thoughts from each team member here today. So let me start by introducing Greg Tacchetti, who's the Chief Information and Strategy Officer of State Auto Insurance. We also have two other presenters. I'm going to quickly have you raise your hand, and then I'll give more information on your bio before you speak. Stephen Lewis also joins us, who's Senior Vice President of MarketBridge, and Amrish Singh, who is the General Manager of Metromile. So it's great to have such a fabulous panel here. And our first speaker is Greg. And as I mentioned earlier, he is the Chief Information and Strategy Officer for State Auto Insurance, and he leads State Auto's IT, customer service, and facilities organizations. He was also an owner and founder of AssureStart, a company that sells smart business insurance online, before joining State Auto in 2015. He was Chief Administrative Officer of Fireman's Fund Insurance Company and Alliance of America, and held senior operations, underwriting, and finance roles with Safeco and Geico. So wow, you know a lot more about insurance than I do. I'm the mobility guru. So Greg, take us away for 10 minutes.
All right, great. Thanks, Carla. Hello, everybody. It's great to be with you this morning, afternoon, wherever you may be. I'm going to just speak for a few minutes on the topic of, what do you need to do to transform your company? I'm going to get to the auto use case in a minute, but I'm going to talk more broadly initially about some of the enabling capabilities. Whether you're at a startup or an existing carrier, I think it's almost cliche at this point to say it's all about the data, but it is all about the data. And what does that really mean? One of the things that I've learned over the years is something that Amazon does a lot. It's called the working backwards process. So if you're trying to deliver a set of services or features or capabilities that you think a consumer may want, it's helpful to start at the end and think about what does that experience look like, what does it feel like, and then tie that very distinctly across your whole architecture, and specifically your data architecture, so that when your teams start to build those experiences, you've got the ability to add very robust capabilities. So that's I think, I don't think that's too controversial, but it's a lot easier said than done. So just a few thoughts on what does a solid data architecture look like? In my career, you've gone from having big block data sets and data cubes, data warehouses, and now the topic du jour seems to be data lakes. I have found, and in our experience, the data lake that we've built with a lot of the real-time services with a robust data model underneath has really helped us move at a pace that I've not experienced in my career. And that is really across the spectrum. We're an old, actually next month is our 100th anniversary, middle market carrier, personal and commercial lines. So we do, like a lot of carriers, have a lot of legacy applications and legacy data. So you're never going to get, a real-time experience out of your mainframe on your older policy admins. But on your newer stuff, you certainly can and capture and deliver that real-time data services if your architecture is set up correctly. We've moved to a completely cloud-based hosting and architecture for our data lake, and a lot of the transformation we've been doing over the last 2 years has been around refactoring a lot of our services to more real-time microservices, which are both more secure, faster, and cheaper for us. Once you have that data foundation in place, moving this to kind of the auto use case, you can set up small product teams, and that's what we've been working on for really the last year, that are able to really move quickly. If you have those services that the team can consume, you're not rebuilding a lot of things, and you have that real-time data, you can now put those applications in front of consumers. Hopefully you've got it 80% right out of the gate because you started from the back and worked forward. But you never really know what different consumer segments or personas you're going to find as you start to iterate in the real world, so to speak, in the marketplace. And that's where having this strong foundation is just really, really important, and really makes the work on the product teams really exciting. Nothing gets a developer more excited than working real time and seeing the fruits of their labor moving the needle for whatever their product may be. And again, in conclusion, it's all about the data and having those real time services. Back to you, Carla.
Thank you, Greg. Great opening. And, data is everywhere, right? And, I just have a quick question for you about data and data analytics. It's really ruling the world, and we seem to have a lack in a lot of organizations for human capital and people who understand data analytics. What's good data? What is, what data should we perhaps ignore because we just have, megabytes of it. How are things in the insurance industry these days related to having that human capital and knowledge and ability to really dissect the data?
Well, you hit on two really important points. It all starts with talent and getting the right people in place. And I think we've been very fortunate in that regard. We've got a really talented data team and data engineering team, and have a really tight on-offshore relationship, so we're able to move very quickly there. The other piece is trying to figure out what you store and where, and in what different capabilities you want around that data. So, we're literally capturing petabytes of data, and a lot of it, you hear the term digital exhaust. And I think you get a lot of that with the telematics. Isn't always actionable. So you really need to work closely with your business teams, who everyone has a bias, to capture all data and never let it go. But you have to have the discipline around your data model and your quality and governance, DQ&G, to be able to work backwards again from what questions you're trying to answer, or that you may even think that you want to answer. It's a really, really important question, and not one that's easily answered. We've certainly had our challenges in that space. Keep all quote data forever, which creates different PII issues for us, and certainly storage issues. So we've got a fairly robust process in place where we're constantly looking at this, since a lot of it is new as we've rebuilt our whole stack. And it's just something that, I had this joke earlier. I'm 30 years in the insurance industry, that you really needed to move offices every 2 or 3 years so you clean out your cabinets. And I actually did get in a discipline of doing that. But now that everything's digital, those filing cabinets are virtual, and you just don't see them other than the amount of data that's in them. So it's a really important discipline to put in place across your organizations.
Well, thanks, and I won't take any more of your time right now. I hope the audience is thinking about questions for Greg and puts them in the Q&A box. And now we'll shift over to Stephen Lewis, Senior Vice President of MarketBridge. And you lead the go-to-market solutions practice at MarketBridge, guiding the development and delivery of strategic efforts with sales and marketing leaders. Stephen has deep industry experience within insurance, financial services, and high tech. His unique point of view helps industry leaders navigate routes to market and business dynamics to drive go-to-market effectiveness and cohesion. So Stephen, over to you.
Thanks. And thanks, Greg. I love your term digital exhaust. I'm actually going to use that because something we see a lot is with the clients we work with, there's a lot of data that doesn't get leveraged or gets leveraged poorly. So it's a great term. And I think the way you set it up is really good in terms of thinking about the data architecture, as well as kind of having microservices that can work off of that. Because what we're seeing, across, a lot of the larger market leaders is they're undergoing, core digitization changes, and, at the same time dealing with a lot of competition, especially, fintech, it's a lovely word. And how do they turn on, customer-centric systems and things like that to address these changes while they're still working on the core? And I think separating those two functions is really a good way. And it's an exciting time. I think customers now have, a strong expectation that they're known by the people they work with. And, there's so much disruption in the industry right now. I think, something like the cost for the infrastructure of an entrant versus an established player is something like 50% higher for IT and operating costs. So, there's really a lag there, and pressure on companies that are trying to transform. And what we wanted to do is really kind of unpack the idea of disruption and how our clients, while they're doing the digitization efforts, can really work at, go-to-market efforts in terms of sales and marketing, things that can be executed while they're digitizing the core. So having an immediate response strategy while the products are changing and while the culture is changing in the organization, and being able to be responsive to customers. And, not to sound theoretical, I think, disruption as we're thinking about it is, adding more value to a product, giving a customer something better, or taking away things they don't need and making it less expensive. And insurance is a really great use case for this, auto insurance specifically, because it's turned into a really dynamic category with regards to disruption. The insurers are able to underwrite and know their customers better, and price more accurately, as well as prevent fraud or identify fraudulent claims, and then really build products that fit the client's needs, the customer's needs a little bit better, such as charging by the mile insurance. And getting there, though, isn't straightforward. So there's a lot of investment and a lot of change that has to happen. And feeling the competitive pressure, the ideas we came up with were pretty simple. How do we turn on some advantages that legacy firms have that can't be replicated easily? And we came up with 4 of these that we think are super strong. And the first is maybe the most obvious, but it's digging in and working with existing customers. So we call it customer ownership. But how do you secure the customer relationships before attrition? And how do you secure the existing revenue pathways? We know from research that younger consumers will switch for experience, and they are underserved, wanting their needs met. They know these new digital experiences, and they expect that from the folks they work with. So how do we address the different customer segments and make sure we're meeting customers in the way they want? And kind of tied to that is leveraging data and insights. Going back to kind of what Greg was saying with all the data out there, how do we make sure that we're capturing that data and leveraging that data and activating it into go-to-market, sales and marketing, to deliver better experiences for customers? And 9 out of 10 consumers, expect companies to know them, and they expect personal experiences. So using data and insights to deliver those experiences in a timely manner is really important. And I think the fourth is, this is something we see in insurance actually leveraged, the auto insurance leveraged really heavily, is using the brand platform and brand recognition to keep relevant. I think the best stat I saw on this is, 4 of the top 10 TV advertisers are auto insurance companies, and Geico's #1 ahead of even Walmart. So they're really digging in and understanding that their brand is strong, and they're able to use that recognition to maintain market relevance. And I think the last is this is maybe a touchy one, but the in-person customer network, so phone and direct human contact, either through agents or direct selling. From what we've learned is customers are really comfortable with digital, and they expect really good digital experiences. But at the times when they need those personal experiences, they really want to talk to a human. They really want to connect, and that's an advantage that established firms have, that they can, and they have those networks of people. And I may never have met my insurance agent, but I know they're there when I email them. So I think the direct human contact, in addition to leveraging your brand and being able to use the insights you have, and ensuring customers are satisfied, those four things we think are really strong ways to lean in and help incumbents manage their business as they're going through that digitization process. Back to you, Carla.
Yep, I just have to, get myself back on the screen. I'm not as quick as I should be, I suppose. Thank you. Really interesting insight about, brand and strategies and the customer side of the business, which I suppose in today's world, everybody expects instant, right? You can chat online, you can get, your quotes pretty darn fast. If you have a claim, they want that, processed quickly. How are companies really, changing that in that regard? Are they able to be as fast as the consumer of today is demanding?
Well, we know over the past, many years, this transformation's been coming, and I think there's been a lot of investment. And going back to Greg's point, having the ability to turn those services on and executing sort of smaller projects that ladder up to the bigger innovation is really how we see it working best. So instead of saying we're going to digitize everything and make everything amazing, picking the key projects and moving forward with those. So for example, taking the claim, separating out the different processes. So taking claims alone and working through that process, and then rebuilding and relaunching that independently of maybe of the acquisition or the customer service areas. So I think separating out the core processes and really understanding those and building those, and then having I think Greg was saying something about we'll get it 80% right the first time. So, but being able to test and then work those changes back into the final product, an MVP approach is a really good way to do it.
Well, thank you for your opening comments, Stephen. I really appreciate it. And Amrish, if you could come back on the stage, I'm going to introduce you. You are the general manager of Metromile. And this is Metromile Enterprise, is a software as a service business group of the namesake pay per mile car insurance leader. And you, Amrish, joined Metromile in 2018 to launch the business group and help insurance companies around the world automate their operations, reduce losses associated with fraud, and unlock the productivity of their employees with automation and machine learning technologies. And I'm not going to go through your whole bio, it's quite lengthy, but what I found really interesting was you're a lifelong technologist, and you've dedicated your career to helping companies operate with greater efficiency and provide a premium customer experience. I'm really interested in hearing what you have to say.
Thanks, Carla. I'm going to actually pick one of the topics that Stephen was just talking about, which is there are areas and there are points in time in the customer experience where customers are interacting with their insurers, where they want a human interaction more than a digital interaction. And one of the things that we've seen is as the number of digital touch points have increased, customers are actually, in certain cases, recognizing that it's a little bit too much. There was a study done where millennials, which is a specific segment within within the customers that insurers interact with, were actually frustrated with the idea that there were too many questions being asked digitally, and they weren't getting a chance to speak with someone on the phone or in person. And I think what that led us to realize is digitization is really this broad umbrella where there are ways to do it right and there are ways to do it wrong. And if you do it wrong, you end up hurting customer experience more than helping it, because the customer expects something different at a certain point in time. So that really resonated with me. I think as we're thinking about digitization, understanding how to be incredibly purposeful and focus in executing a digitization roadmap is really important. But going back to the topic of today's conversation, when I think about disruption and innovation, I really look at this as with two different perspectives. Companies disrupt when there are market forces that are making them act and make a change, and certain other companies disrupt when they see opportunities in the market and they want to seize the moment. And I think both of those perspectives are really important in understanding how auto insurers are bringing out disruption. On the market forces view, which is essentially what's happening in the market that's making you act, there's a couple of really interesting things happening. One, there's a downward pressure on premiums. In general, with COVID, people are driving less, which means there are fewer claims, which means also the expectation is that customers are going to want rebates, which is going to bring down premiums, which is obviously going to make insurers react to that challenge. But the other interesting thing that's happening is more and more cars are getting more signals, and they're getting a lot more safer to drive. I drive a car where it's really difficult for me to actually have an accident. It automatically stops if I'm about to hit someone. It reacts if I'm drifting away in my lane. And what that's telling me is that cars are getting safer, claims are getting fewer. The frequency of claims is reducing, but the severity of claims, because these cars are a lot more expensive, these sensors and signals are a lot more expensive, the severity of these claims is increasing. So there's a challenge that insurers are facing where premiums are reducing, but severity of claims are going to go up as accidents do happen, and insurers need to find a way to react to that challenge. What it also implies is that good drivers want rebates and bad drivers need to get identified, and they shouldn't get the same rebates that the good drivers are getting. The other challenge I'm seeing from a market forces view is an upward pressure on improving customer experience. I think Stephen talked a lot about this. The idea that customers want a digital self-serve experience is incredibly important. It's there, and it's the need of the hour. Customers expect that because they're seeing that in their entire digital life. But also figuring out how to do that right is really important for insurers. The third thing I'm seeing is that with auto insurance, there's a need for insurers to find a way to differentiate, right? One of the ways that they differentiate is through advertising, but customers are getting smarter and they want to understand the product they're buying. And so insurers are facing pressure in figuring out how do they differentiate their product from the other car insurance products that are out there. With Metromile, for example, we offer pay-per-mile car insurance, which is very different from a traditional form of insurance. There's a second view, which is an opportunity-focused view, which is if I'm the insurer, rather than looking at what's happening outside that is making me react, are there opportunities outside in the market that I can react to and seize the moment and create a long-term sustainable competitive advantage? If you're an insurer, you're trying to make strategic decisions that are long-term in nature and that are sustainable in nature. That really creates this long-term advantage where you get the maximum amount of investment, returns on your investment. And from that perspective, it's exactly what Greg was saying. The ability to access data, harness it, and make value out of that data is the biggest opportunity that insurers are seeing right now. We're seeing insurers use data for a large variety of use cases, starting from building lifetime value of their customers, understanding the different customers on the book and which of these customers are at risk of churning and need more attention. Are there other customers that are there for the long run and need a lot more nurturing in helping them identify more products to sell them? And a lot of that is possible using data, but more importantly, taking the data and finding useful insights out of this. And I think that's the challenge that insurers, auto insurers are facing. Those that are disrupting are finding really interesting ways to use that data Steven talked about fraud detection, which is a big focus area in our industry and a classic use case of how that data is being used. But it's a lot broader, right? It's across the entire value chain. It's in distribution, in product, in servicing, in claims, and that's all being made possible because of data. I think the next big thing is customer experience as well. I think the opportunity perspective is every insurer now needs to have a digital self-serve experience. They need to have the ability to, as you mentioned, Carla, file claims or have claims received and issue payouts to claims for the less risky claims within a day. Because that's what insurers are expected to do, and that's how they can potentially differentiate themselves from other insurers in the market. But again, that's also really challenging because insurers need to be incredibly purposeful in how they prioritize their digital roadmap and their customer experience roadmap in order to get the most out of their investments. And again, there are certain insurers that are doing it incredibly well and they're getting those returns on a short-term basis, and others are faced with long-term core modernization projects, which are 24 to 36 months long, where the path to value is 5 years rather than the next 1 year. The last point I want to talk about, and this is incredibly specific to auto insurers, is the idea of the connected car. 50% of the cars that are out there in the US right now have some form of signal or the other. It doesn't have to be an expensive car. Those cars have signals built in. The cars have operating systems that have the ability to syndicate signals, but people haven't figured out how to use those signals. In the long term, in the next 10 to 15 years, 95% of the cars out on the roads are going to have signals. And so this is a really interesting opportunity for car insurers to find a way to harness the power of the connected car. That again, those data and those signals are going to impact the entire value chain in helping understand how to build a more differentiated product, in helping with distribution, but also in obviously helping with claims management. And so as you're an auto insurer thinking about how do we learn from the disruptors, how do we introduce more innovations, understanding what's happening in the market, which is a market forces view, is important to see, what's something that everyone else is facing that we have to react to, but then going really specific and seeing opportunities that they can harness and go after is really important. And that's going to vary from insurer to insurer. Every insurer has different priorities, different challenges, but the ones that are going to be successful are the ones that will take their specific competencies and their specific challenges and build a strategy that's very specific to them. Back to you.
Thank you, Amrish. I just have one question, and there are great questions coming in from the audience. Keep them coming in. I have one question before I bring the whole panel back together. And you mentioned the customer experience and how important that is. And my question may be naive, but how does a customer judge their experience? Is it based on, gee, they covered my whole claim, I'm happy? Is it based on speed? Is it based on the number of options that they're given to select from? What are those parameters that go into saying, yeah, it's good?
Yeah, that's such a great question. So the answer to that is it's a no size fits all kind of an approach, right? I think what insurers can't do is have a single focused view on what an ideal customer experience is going to be. I think this is the major challenge, right? I talked about the statistic where, the customers are just saying, there are too many interactions happening. What we've learned is the concept of dynamic reaction, which is you build out your customer experience where you're reacting to what the customer is, what you're getting from the customer. If you've got a customer that's coming in through a digital channel and is looking to engage with you on a digital channel, you as an insurer have to react to the fact that they're more digital focused and respond back via digital channels, right? I think this is where the way you build out your roadmap and you are able to respond back to the needs of the individual customer is so important. There are other customers that are calling you from the call center. The last thing that customer wants is that they're calling you from the call center. They're calling the call center. They are speaking with the claims adjuster, but they're getting bombarded back with automated emails and AI bots and all of those things. That's not going to work, right? I think so. We focus a lot on this concept of dynamic reaction, reacting to the needs of the individual customers and building a customer experience where you're able to respond back to how the customer reached out to you, and choose the medium that's important, that's important for each individual customer.
Thank you. Let me bring the other panelists back. And first thing I want to do is, see if they have anything to append to this customer good experience question. And Amrish, I have to admit, I see on Twitter a lot of these AI bot conversations that just go, pooh, really? So, there's a lot more that needs to be done in artificial intelligence for sure, to get those systems at the level that really the customer expects. Stephen or Greg, do you have anything to append on that question, or shall I go to the next?
Yeah, no, I think Amrish's point around, the creating dynamic experiences and reacting dynamically is really important. And being on the end of delivering those, I think it's really important to understand the different segments of customers and be able to capture the right data on those customers and meet them where they are. So if they're, like you said, if they're reaching out to you via email, respond via email, or if they're a call center user, we need to know where they want to go and how to meet them. And I think it's also important that the systems on the back end kind of tie together that data, so that if someone does, if someone's a person that prefers email and they have some reason to call, that experience becomes connected, and we're able to kind of manage them in a really dynamic way. So I think it's really important to think about the segmentation and understand customer preferences for sure.
Yeah, I don't have a whole lot to add. I think Amrish and Steve just hit it really, really well. The only thing I would add is, with respect to those customer preferences, you really have to be discreet all the way down to specific product line and transactions. You may want email for your general correspondence, but in a claims scenario, you may want to change to text. So you've got to have your systems be that well segmented.
Yeah, absolutely. Well, thank you for those answers. And then I'm going to ask another question, and then I'm going to move to the audience questions. My question is about, in today's insurance world, and probably this feeds off what I was just talking about. Back in the olden days, you used to be able to go down to Joe's place down the street that owned, the local branch of whatever insurance company, and you had a relationship with him, and you could get whatever done, him or her. In today's world, are we seeing more and more of those smaller agencies becoming part of bigger conglomerates? And is that causing any issue with the customer service and individualized service that people are expecting? And are we going to continue to see more of these big mergers because the little guys just can't stay competitive? Any view on that from anyone?
Well, we sell through independent agents, which I think is probably the best case that you're referring to. A lot of the captured agents, State Farm and Allstate, are kind of shrinking, and that's probably the only category of distribution that's really shrinking. What we refer to is aggregation. So you have bigger corporate agencies that are consuming the smaller ones, and it's not, what we see is much about the smaller offices being able to compete. It's really, I'll say, a demographic issue. A lot of the smaller offices are at a point in time where the owner wants to exit, and their 401 is basically the value of that business and the multiples they're getting right now. I mean, 20 years ago when we first observed this trend, when I was at Safeco, we thought the multiples were pretty, they've been about the same for 10 years, and then they kind of shot up, and they haven't stopped for probably the last 15 years. So it's less about competition. I think that there is a consumer segment, a big segment, that still wants that personal relationship, and they want it local. They don't want to really spend a whole lot of mental energy trying to figure out insurance ease and contract this and that. So they lay that off on a trusted advisor, which typically in our world is that independent agent. And I think it's remarkable, if I put on my strategy hat for a minute, if you look at the broader industry, yes, Geico and USA, particularly on the direct side, have consumed market share, but in the face of billions of dollars of advertising spend every year, and probably multiples of that for all of us spending on IT to try and give better customer experiences, that independent agent channel really has not shrunk outside of the auto product line, which is the biggest P&C line, but has not shrunk really too much in the homeowner space, and almost none at all in the commercial space.
All right. I'm going to move into some audience questions now because they just keep piling them in, which is good. Everybody's been talking about disruption, and one of the questions is, besides cloud transformation, what do you believe has been the most disruptive trend in insurance? And maybe we'll start with Stephen, because disruption was a large part of your opening comments.
Absolutely. I mean, I think telematics is sort of one of the starting points, and I think it's still not to the point of full realization. I think where I think everyone gets excited about autonomous cars, and I think that's kind of the thing that's really going to be disruptive as we need to rethink how insurance deals with autonomous cars. And there's a company out there, Avenue, I think it is, that's kind of building models for insuring autonomous cars and understanding when those cars are autonomous and not. So that'll be really, really interesting. And then on the business side, the idea of kind of on demand or pay per mile is super cool, as well as there's ideas around peer-to-peer and sharing. Those are kind of out there, micro insurances and things. But it's an exciting time, and it all comes back to like the data. There's so much data coming from cars. There's so much data coming from customers, and how that gets merged to give a better experience, but also a better product. And I think there's a lot of smaller entrants that are adapting, and then the larger companies kind of adapt what they learn from there. Going back to the market forces around Amrish, they're able to kind of leverage those learnings and see what's working and work those into their portfolios on their architectures.
Yeah, I'm going to add. Yeah, I think just adding to what Steven said, what's really interesting with the idea of telematics and the connected car is we're moving from a world where insurers had, large segments, a large number of people in one segment, and data that spans, months or years, to a point where you're getting 10 signals a second, right? 10 hertz is a traditional frequency where the car is syndicating data. And that leads to a massive amount of opportunity, right? Because you're suddenly going from, similar to being at a 50,000 feet view to a 5 millimeter view, and the ability for insurers to react to that. I mean, I can imagine a world where if you're doing autonomous driving, and this is reality today, is the risk profile changes the second the autonomous car takes over, and it changes again when the driver takes over. And so you will need to have two forms or two different premiums attached to the same covered vehicle, depending on who's driving the car. But all of that is being possible using telematics and data. And obviously, in Metromile, we think a lot about that problem. The other thing, though, related to that is, or let me flip it. I think the one challenge I often face when I hear about cloud transformation is this idea that it takes a long time to get value, right? Return on investment. Every time I hear about cloud transformation, it's a 1 year, 2 year, 3 year program. Hey, we'll achieve XYZ benefit 3 years from now. And obviously, as a technologist, that pains me, because we're living in a world where answers need to be immediate. We're in an immediate gratification world where even big enterprises like ours need results sooner. And so there are different ways. There are ways in which insurers can get value faster, but it's more of a pain, right? I just hate the idea that it takes so long to get any value back.
Greg, do you have any insight about that from a data architecture standpoint? And
this is one of my favorite questions, and I get it a lot. And I will say, when we talk to people in the industry and our board, big part of our high sense of urgency is we believe the industry is heading into a potentially very disruptive time. We've been talking about UBI and telematics as kind of one use case, but the data that is being generated And I think Amrish used a great example. You used to use age, gender, marital status, as big, huge rating plans in auto. Now you can really get that detail. But the data being generated from sensors across a wide spectrum of our lives is going to, in my opinion, help us as insurers better understand risk, whether that's imagery of seeing roof conditions or tree limbs hanging over roofs, or water cutoff, water drippage inside of houses. I mean, there's a wide range of sensors and data that will help insurers that have their antenna up to consume that data understand risk in a much more granular way. I think telematics at this point is probably one of the more mature examples in the marketplace. And as I said earlier, auto is the biggest product line, but there's another $600 billion of P&C in the US that isn't in auto that I think is potentially going to be disrupted very similarly. And that's, you got to have your antenna up. You've got to be working with people that are kind of on the cutting edge. There's a lot of cool insurtechs that are doing great work here. You got to have the data, you got to have the team that can analyze it, and you got to have the partners that are helping you kind of consume all of that.
Greg, let me just expand on that question a little bit, because you mentioned about non-auto. And, one of the things in today's connected world where, your refrigerator's connected to your phone, your car's connected to your phone, your mobility service, your public transit, your Amazon, everything is connected. Eventually drones and everything will be connected. Is there something more holistic that insurance needs to be thinking about, that, you won't have these separate, different policies, because in essence, everything is connected?
We did an exercise with our board 4 years ago. We got to probably dust it off, where we picked 4 disruptive end states and projected out to 2022. It seems like a lifetime ago now, but we're kind of on the end of getting right to it. And what the idea was to take these disruptive end states and then work backwards from 2022 and say, if this was my future, what would I do about it? And one of those, I think Stephen mentioned earlier, was this episodic insurance. But a lot of them were more around disruption of distribution and how that may take place. But the big one was around disruption because of all of these data and, as you say, things being connected. I saw one of the other questions about insurers working with carriers. The car manufacturers are understanding, I think, more and more every day, the value of the data that they're generating and the vehicles they're producing. You already see Tesla trying to monetize some of that with their own insurance product. So I think if you look at this, from an industry point of view, that's probably the one thing that we don't talk a lot about, is the potential disruption of just manufacturers, because they have that data too, rolling insurance right into their products. And that disintermediates, carriers from a big chunk of that potential revenue stream. So, as I say, I think we're heading into a potentially very disruptive 5-year window. And then the companies that are able to react quickly and very nimbly to whatever people figure out for use cases with these data that we're talking about are the ones that are going to come out of it. But there's, I don't know, 2,600 something, P&C carriers right now. Probably 2,000 of those are less than 300 million. You wonder how they're going to get through, both the talent war and the data war that's on the horizon here.
For sure. A lot of questions coming in about autonomous vehicles, and Amrish, you kind of alluded to, hey, with ADAS systems, smarter cars that aren't, crashing as much. We're seeing larger claims though, because the systems are getting very complex. A bumper today has, 4 or 5 different sensors, maybe a camera, lots more wiring. So when something is damaged, it's a lot of money to fix it. As we move into autonomy, and in theory, cars that should never crash, what is the insurance agency thinking about that, and how we're going to move through that transition, and what the different policies may be for cars with different kinds of capabilities? Let's just tackle that one because a lot of people are asking about that. Who would like to take that one first?
I mean, I can start and others can add in. So I think Greg touched on a really important topic, right? OEMs have the data. They're the ones that are generating the data. And so insurers are trying to figure out, okay, how do we get involved in this? Or, are we going to get pushed on the sidelines? I think it comes back to the idea that insurance and auto insurance in particular, because you're spending billions of dollars in advertising, indicates it's a commoditized industry, which means you need to find a way to differentiate yourselves. Those insurers that can pick on this particular data and create products that the car manufacturer does not have the capability of doing, right? Their competency is about building metal-based things, right? Their competency is not using actuaries and claims adjusters in offering insurance. But the insurers that can take that data are the ones that are going to win out of this, right? So going back to the idea that severity is high, that's going to be the case. These cars are going to be more expensive to repair, which indicates that the claims management piece needs to get a lot more intelligent, right? When an accident happens, how does the claim organization get access to the massive amount of fidelity that's available in the accident that just happened? Just, if you've got your phone and I bang my phone on the ground, I can, using that data, and it's got the same amount of sensors that a car has now, know exactly the direction of impact, the intensity of the impact, and also recreate based on where exactly the impact happened, who hit me, or did somebody hit me, or did I hit them? All of that information needs to land in the hands of the claims adjuster. That's how these insurance companies will recognize and handle the massive severity that comes with claims. It's going to also allow you to reduce fraud, right? You've got now telematics data. You can recreate the accident if you wanted to, which will help you, capture fraud. So I think the answer here is it's going to get more expensive because cars are getting more expensive to repair. But that signal data is going to also give you more fidelity in claims management. And insurers that can access that fidelity and use that information for processing the claim will not see a dramatic impact because their cost of processing is also going to go down.
Greg, I see you shaking your head. Do you have comments you'd like to add?
Yeah, I completely agree. One minor use case that we put in place actually a couple of years ago now, when we had telematics customers that were registered, when we picked up on that sensory impact, we immediately texted and then called. And we actually, there was a fair number of false positives until we got it tuned, where someone dropped their phone in a car and said, "No, I'm fine." No one complained about the call, which was really good news from a customer perspective. But I think I just saw a Google phone commercial along these lines in the last week. But yeah, it's how you think about all of these things and try to get them both automated and more intelligent. With respect to the original question on automated vehicles or autonomous vehicles, the technologists and a lot of us, see that as a when question, not an if question. And I was probably, if you triangulated on all the experts, they were probably, 20 years out. I'm probably closer to 10. But if you start thinking about the fleet turning over and 5% of the vehicles, 10% of the vehicles, when you get to 20% of the vehicles on the road as autonomous, actively avoiding every other car around them, all 5 of those cars got a lot safer, right? And that's where I think the frequency question, this was one of those disruptive end states we picked 4 years ago, was at the time, $300 billion in auto and home insurance goes to $150 billion. Because of frequency reduction in auto and other loss avoidance things in homeowners. And so the exercise was, now with that paradigm, what do you do? And to my earlier comments, it's carnage, right? Most insurers have a very high fixed cost base, whether that's people or facilities. And if they're running a mid-20s expense ratio and all of a sudden their premium volume gets cut by 30 to 50%, their rates are going to be unaffordable, right? So that's part of why we talk about this internally as a very potentially disruptive time that we're moving into.
Stephen, let's talk about the customer a little bit. I mean, we've seen We've seen lots of things happening with Tesla lately about, you know, some of the incidents that they've had on the roadways and monitoring the consumer and how engaged they are. We've had, you know, dongles for a long time, so you can get good driver score and get your premiums reduced. Are we getting any inkling how much the customer is going to allow us to take their data? How much intrusion is okay? And are we going to have the flexibility to let the consumer choose and still be able to get the information that we need to better service their needs?
That's a really good question. I want to go back to something Greg mentioned around kind of the premium reduction and that piece of it. I think I saw somewhere that, you know, it wasn't quite 50%, but something like 25 premiums may go down because of this, you know, up to 25%. And I think it comes back to your question, Carla, around the data sharing piece. And there may be, well, Amrish said there could be two models, one for autonomous cars and one for, you know, old cars. There could also be different pricing models based on what the consumer is willing to share and what their privacy comfort level is. And I think that's an opportunity where we want to, you know, create plans and create comfort with customers who are willing to share that data, but also understanding that if customers aren't quite there, there's pricing models that are still attractive and able to capture those folks. And I think privacy is going to be one of those things that, you know, insurers really need to, you know, give confidence that this data is helping them. I think someone referenced, I think Carla, you referenced like the route example where good drivers get discounts and things like that based on the data. I think that'll be one end of the spectrum, and then the other end of the spectrum will perhaps be customers that want more basic plans and more basic coverage. And I think carriers need to kind of adapt and create plans for all those folks to maintain both the margins as well as kind of overall premium basket that's out there. I think ultimately, I don't think it will go quite that 25% because the cost-based and the actuarial tables will reflect those, but I think there is a downward pressure that technology will help companies address in the efficiency side.
Great. Anybody, Amrish, would you like to have any comments on this consumer watching side of the equation? Or
yeah, we offer, we operate a car insurance company, and then we license our technology to other insurers. And one of the big things that we do is, how do insurers use information coming from the car to create more value across their value chain. At the end of the day, in car insurance, more than anywhere else, the customer is king, and the customer needs to be able to decide whether, how their data can be used. And luckily, we have a lot of data protection guidelines already defined in regulations, right, which we have to respect and adhere to in order to, offer our products. But in our case, we are also, with so much technology, I think the advice we always give insurers is to let the customer decide how their data can be used. So, for example, in the classic example of fraud detection, the insurer should be able to ask the customer, all of this data that's coming in, how should we be using it? Or in their privacy policies, present the right, way in which their data is going to get used. In general, macro in the industry, we as consumers living digital lives are having our data being used in so many different capacities anyways, right? And so customers are okay in general with the idea of letting the data get used, as long as it's value added, not exploitative. And so that boundary needs to be respected by insurers and by car manufacturers and by the third-party data brokers in the middle of that entire value chain.
Thanks. One great question came in about, now that we have all this big data, are insurance companies going to be able to adjust the rates based on metrics, the weather, is the driver sleepy, real-time traffic? If I use road A versus road B, because we know road A has fewer accidents or, less complications, will I get a reduced rate? Are we going to see that kind of complexity coming? And, that kind of rate adjustment, dynamic rate adjustment part of the picture anytime soon. Or maybe it's already there and I don't know about it. Greg, you're smiling. You're the data guru. Let's go.
I wouldn't say that, but that was my topic for the day. Keep in mind the mechanics of our business. You can analyze a lot of things, and you can try to then package those into products. But ultimately, we're regulated in 51 markets across the U.S., and each of those ideas that you want to try to submit need to get regulatory approval. So you have to actuarially justify that they are not unfairly discriminatory, and that becomes a challenge with a lot of these types of ideas. We have contracts run a period of time, 6 months, a year, whatever, and being able to dynamically price is something that I think is attractive to certain segments, but you've got to figure out how to do that in a way that that segment of consumers sees that value proposition and is willing to pay for it. And usually that is in the terms of less premium, but you've got to have it be at least explainable, rational enough that you can get regulatory approval for it.
Any other comments on that one?
I'm going to add to something I think Greg mentioned previously, which is, with this data, the ability to identify risk is getting better than ever before, right? I personally believe that we need to introduce a lot more fairness to insurance, right? There's certain factors that really shouldn't be impacting car insurance. For example, my credit score or my gender. But there are other factors like how I drive. And am I hard braking a lot? Am I cornering a lot? Is my automated brake system getting activated a lot? So I think that part is important, where I think long term, there's going to be a lot more fairness introduced in insurance by relying on those factors that actually, signal risk, rather than some of the more, demographic factors. But again, regulation is going to decide a lot of that.
Absolutely. And there was another question that came in about looking at self-insuring and ride-sharing services, this kind of thing, as companies fundamentally start to self-insure, be it autonomous or even in cases where people are driving themselves. You mentioned Tesla earlier. Are we seeing more companies thinking about doing this kind of self-insurance? And does that portend anything important for anyone as we shift perhaps from car ownership to car usership in the future with mobility packages? What are we seeing trend-wise there?
Before COVID hit, we were doing a lot of exploration with ride sharing, but the cars themselves and the company, actually we were insuring some of their commercial lines. But I haven't seen anybody go to the self-insure. If you're a small business owner, just like if you're a regular consumer, self-insurance isn't always an option. You have to put up bonds and other things like that, or other forms of capital that you probably don't have, or, so insurance ends up being the most cash efficient way to lay off that risk. So yeah, I think there will be more and more ride sharing as we exit this COVID period. I was worried a number of those companies weren't going to make it, but I think they did get some protection from the paycheck protection plan from the federal government. And as we're starting to return to the office now, we're starting those conversations again with a lot of the ride sharing groups that we were experimenting with pre-COVID.
And another great question, then I'm going to wrap it up, is, are we seeing anything related from auto insurance that we're learning, or the data that can maybe be applied to other areas within the industry, be it health insurance, et cetera, to be able to, help with some of the costs that we're seeing there? Any insight on that question? That's a tough one, I think. But
yeah, it's a good question, though. I think some of the things we've learned in research has been, customers want to be addressed as an individual, but addressed as an individual for multiple needs. So I think carriers that are able to leverage data across their health may be a difficult or challenging one just because of HIPAA and things like that. But I think building policies around the whole customer picture and using broader data there can help carriers even now provide better packaged offerings for customers and be able to kind of serve them how they want to be served, be it different P&C lines or other insurances that they may recommend. Customers are looking for things to be packaged in a simple, efficient way, and not have to kind of think about it on their own.
Thanks, and we are completely out of time. I'm sorry, it is noon straight up. I think this can be summed up very easy with one word: data. Data analytics. Let's use data. Let's understand the customer and, create that relationship with the customer utilizing that data. So I'd like to thank Amrish, Stephen, and Greg. This has been great. And all the people in the audience, have a great rest of your day. Thank you so much.
Thanks, Carla. Great job.
Thank you. Thanks.